Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. The commodities sector is in a period of extreme volatility, and this story might get significantly worse through the course of 2022. Today we're talking liquidity crises, margin calls, doom loops, and disorderly markets. There were existing challenges before Russia's invasion of Ukraine, related to COVID, related to a lack of financing and liquidity in the sector. All of these challenges have been put on steroids with Russia's invasion of Ukraine. Our guest today is Javier Blas. Javier is a co-author of The World for Sale, the best-selling book on the commodities sector, which is available in paperback now in Europe and will be available on April 21st of this year in the US, and also the Spanish edition is coming in May. Javier is also the Energy Columnist at Bloomberg Opinion. As always, you can support the show by giving us a review on the platform you're listening on. This helps those algorithms in those platforms promote the show to a broader audience and thus help us to continue to get impactful guests and insight on the sector. And as always, I hope you enjoy the episode. Javier, welcome back to the show.
My pleasure. Thank you for having me again.
It's a timely episode, and I'm pleased that we can have you back on because there is a lot in the news about commodities. There's immediate impacts of the events in Ukraine, which we're going to talk about. There's also, whilst it seems a relatively small story at first, what's going on with the LME and nickel pricing. It plays into a much broader issue that is really the summation of what the challenges the commodity world faces, and that's liquidity, that's doom loops, which we'll talk about, but essentially these high prices, this extreme volatility is putting real pressure on traders on how they finance their business. So that's where we're headed. Let's start on Ukraine. Can you walk us through? It's an enormous subject for the commodities markets, and it's obviously tragic events that are going on. Can you just help us understand kind of the immediate impacts of Ukraine, the backdrop to what's going on there, and how that is impacting the commodities sector?
Well, Paul, that is the real story right now because the global economy, the world is suffering a massive energy and commodities shock as consequence of the Russian invasion of Ukraine that started in late February. If we start with energy, Russia exports roughly 8 million barrels a day of crude and refined products. About that is 5 million is crude and close to 3 million barrels a day is products. A large proportion of that diesel and fuel oil going into Europe. We are beginning to lose some of that production. Russian output is starting to drop, perhaps not as much as people like or agencies like the International Energy Agency have expected, but certainly production is going down. Inventories in Russia are increasing, and even some of the flows that they are out there, they are getting into ships, into tankers, but those tankers don't have a buyer. And in some cases, the oil or the refined products is ending on storage, which is ironic considering how tight the market is and the fact that we are releasing crude and products from the strategic petroleum reserves. And at the same time, the Russian oil is ending into storage because no one can buy it.
This is an important point here. As yet, energy has not been sanctioned per se, energy exports from Russia. Now, certain countries have banned the importation, but what is going on here is effectively, and we hear this term a fair bit, is self-sanctioning, which is a real challenge for organizations involved in the global oil trade, because you're not able to use force majeure to get out of these contracts because there's a lack of buyers basically, which is causing some real challenges right off the bat.
Yeah, that's exactly right. I mean, the self-sanctioning it's very difficult for the trade industry because legally you are still having to take some of the cargoes. You cannot invoke force majeure as you will be able if there was a new law or a regulation from the European Union, for example, that impose an export ban or an import ban. We are beginning to see that energy is coming into the attention of policymakers. First, now with the G7, the European Union in full block banning imports of Russian coal, which is not perhaps as a big issue as oil or gas, but certainly is the first time that the European Union is going into the energy area. And I think that the conversation towards oil is just starting, and at some point will come. And gas continues to flow, and that I think that if there are sanctions on Russian energy, we will start with coal, will follow with oil, and the last one will be gas. And but perhaps the sector where we are seeing already the biggest problems, and perhaps the one that it could have uh, the bigger geopolitical consequences in the short and medium term is agriculture. Ukraine itself is a huge exporter of vegetable oil, particularly sunflower oil, and Russia and Ukraine together account for 25% of global wheat exports. We are beginning to see prices really rocketing, food inflation spreading around the world, and a lot of concern for poor countries which are food deficit and they rely a lot into the flows of the Black Sea, whether they are going to have enough food later on this year. So far, the good news is that the rice market, which played a big role in the 2007 2008 food crisis when rice prices exploded, this time prices remain really under control and actually 10% lower than a year ago. And in metals, which is surprisingly the one that is getting less attention by the market, but prices also going up. Russia, obviously, a big producer on some metals, notably aluminum and nickel. We have had the troubles on the LME, but again, a lot of tension there. And in metals, like in every other market, it's interesting because it's just not the war in Ukraine that has really triggered these price spikes. The foundations of the price spike were already there. Inventories everywhere are very low, whether you look at oil, whether you look at gas, whether you look at metals in general. And the war came on top of that trend, and it just kind of became a massive catalyst that accelerated the price rise. But I think that even if Russia has not invaded Ukraine, we will be facing high prices, perhaps not as high, but certainly the market will be looking still quite tight.
Yeah, and the one allied to mining is, of course, fertilizers. We're already seeing the impact on in East Africa, for example, of these rising prices. They rely very heavily on Ukraine and Russia for wheat. That fertilizer story, I feel, is the sort of slow-moving iceberg but is going to be an enormous impact, when it happens, because you've already got deep worries in Brazil, other producing regions, that you've suddenly found yourself, Russian fertilizer production cut off, right, or very much constrained. That could be a huge impact as we enter the growing season in the Northern Hemisphere.
Absolutely right. And fertilizer and steel, I sometimes refer to them as um, the commodities that no one really think about them because they are not sexy. They're taken for granted. Of course, the fertilizer is going to be there. Of course, the steel is going to be there. I mean, they are produced everywhere, etc., etc. But they play such an outside role in our global economy. Without fertilizer, your crops are not going to grow as much. Your yields are going to come down significantly, and without steel, well, that's the foundation of modern economy. You cannot do much on the global economy without having a steel, particularly the construction sector. So it's very important to highlight both commodities because I think that both are going to be problematic in the next few months. And as you are pointing, Ukraine, Russia, Belarus play a huge role in those markets for fertilizer and steel. And we're going to be very short of them. And I don't think that shortage is a question of a couple of months, but something that maybe stay with us through the whole of 2022 and going into the new year.
Mm. So going back to energy, it's interesting you say so coal first, then crude and products, and then gas. And I think that's intelligible to all of us why, gas would be last on that list from a European perspective, especially while we're still in winter. Um, Staying on crude and products, is this self-sanctioning, this idea that we saw very publicly, Shell buying in the window and having all the knock-on effects from stakeholders and shareholders as a result and promising then not to do it? is is this a is this the traders themselves, taking a stance, or is this the fact that they're more worried about or can't get access to the financing to be able to do these trades? Where is that sort of divide fall?
Well, I think a lot of the self-sanctioning is coming from public pressure on companies, and it's notable that you could see a correlation between listed companies and more self-sanctioning, more privately owned commodity traders, very little self-sanctioning. Um, it's a lot of public pressure. If you are a publicly listed company, you are going to have to take a public stand, and also for the majors. Thinking about Shell, Total, BP, it's not just the public pressure that could come from the equity market and their shareholders. It's also that they could face boycotts. Ukraine is waging a very, very effective and very smart uh, information campaign around the world, and it has been very quick to name and shame any European big oil company that has been buying Russian oil or Russian products. And that means that consumers in the West take notice, and the use of social media in particular, and there are calls for boycotts. And a lot of these companies have thousands of petrol stations in Europe that they really need to protect. They want that business to continue, and they cannot be in situations in which they face boycotts. And I think that the industry is learning lessons from what it could sound ironic, but it's very, very similar. A lot of people are looking at how the diamond industry went through the wars in West Africa about 30 years ago. And the initial reaction of the diamond industry was pretend that it was not a problem. But ultimately, the pressure was very significant. And the diamond industry had to stop buying conflict diamonds or blood diamonds. And I think that the oil industry is looking at that and learning the lessons. And that's what we have seen some of the self-sanctioning happening. And then you are right. The traders in particular, the Achilles point for the traders is going to be the banks. And you do not want to be seen as profiting a lot from the war, as taking a lot of Russian oil beyond what you were taking in the past, and that financed by the banks, because the banks simply are going to say, no, sorry, we are not going to finance that for you. And keeping the banks on board is absolutely crucial for the commodity traders.
Yeah, which we'll come on to why in a little bit. Just staying on that, the large global oil traders, independent oil traders, have always made significant trade by buying long-term Russian oil, and over a couple many years, and financing that in kind of 2-month blocks or whatever it might be. I don't want to get into who's got what, but how significant a challenge is that for those independent oil traders that have these take or pay contracts with Russia?
Well, it's very significant. It has been a huge source of volume for the commodity traders, and those are long-time agreements, as you say, that they were signed before the war. And the traders cannot just say goodbye to their counterparties in Russia, because legally they need to continue fulfilling those contracts as long as there are no sanctions on them. Um, so and they are also very profitable for the commodity traders. I mean, those barrels are now massively discounted, and they can find, if they can find a buyer, well, then they can make some very good money out of them. How long the European Union is going to allow that to continue? I think that probably longer than many people think. But and also for the commodity traders, the other thing is that it's not that only that they have those long positions on Russian oil, they have also shorts to fill. They have agreed to refiners in Europe and elsewhere to supply some kind of barrels, and they're using those Urals barrels in particular to fill those short positions that they have with European refiners. So if one day they cannot take the Russian barrels, their long position is gone, but the short position may still there, and they may need to find a replacement because their contracts with the European refiners have some optional origin clause. So it will be a double whammy for them, losing the access to the Russian barrels and still have a short position in somewhere in a refinery in Europe or elsewhere that they need to fill, and that could be for a trader the worst of the possible scenarios.
Yeah, yeah. And then there's another thing that's happening as well, which again plays into this liquidity challenge that the markets are going to face and do face right today. And that is, we've also seen, as a consequence of Russia's invasion, a number of significant energy traders exit the market. You know, obviously Gazprom is a very clear example of that. That's further just draining market liquidity from the sector. Do you see that as a continuing trend? How has that impacted the energy trade?
Well, I think that the Russian traders are going to have a harder and harder time dealing in the European market, in part because of self-sanctioning, in part because at some point specific sanctions are going to come on the leadership of those Russian trading houses or their parents' companies back in Moscow. So I think that they're gonna face a lot of challenges, and I feel that European banks are going to be extremely reluctant to continue supporting them. So how that's going to play out, we don't know yet. At the same time, they hold massive positions in the market, hedges, prop trading. If that needs to be unwound, that could be quite messy. As for the other traders, what we are seeing is that really the small and medium-sized traders are just struggling to get access to credit because there is a flight to safety and to quality. So the banks prefer to bank with the top tier of the commodity traders, and they're abandoning everyone else. And I don't see that changing.
Yeah, yeah, no, absolutely. And before we move on to the LME story and nickel and why that's sort of a template potentially for what's about to happen, I don't want to sound too doom and gloom or a Cassandra in the market, but what's one product that has absolutely hit the media that sort of, I guess, very close to consumers' hearts, aside from food, obviously, has been diesel. Are we just at the start of the run up in prices, really across the product suite and commodities in general? Do you think, as a consequence of just these seismic shifts in how the market is operating, as a result of not only the super cycle that's been going on before in the energy crisis, but now as a result of Russia's, de facto sort of removal from the sector?
You are absolutely right in highlighting diesel. That is the product that probably is in shorter supply. Europe is very short of diesel. Before the war, it relied significantly on Russian diesel and on also Russian semi-refined products like vacuum gas oil and fuel oil to produce more diesel locally here in Europe. With that removed, the market is short. Is unlikely to get any better. And the problem with diesel is really, I call it the workhorse of the global economy, is everywhere, whether it's trucking or farming or heavy machinery or freight, ships. It powers the global economy, powers transportation. The moment that diesel prices go up and we have beginning to see significant price increases, soon everything goes up because simply every good needs to be transported, and it's transported on vehicles or aircrafts or trains or ships that they use some kind of middle distillate, whether it is use diesel, low sulfur, marine diesel, jet fuel, and the price of transportation is just going to go significantly higher. And that means that everything else is just going to be more expensive. Can we see shortages, actual shortages of diesel? I think that that's possible. I think the market just generally is extremely short of that. However, I think that in recognition to that and in recognition of how the strategic oil reserves in Europe are a bit different from the US, where most of them are in the form of crude. In Europe, we have refined products, but in this new release from the International Energy Agency, we are going to see quite a lot of middle distillate being released into the market, already refined, So the diesel situation in Europe should get a bit better thanks to a significant release of diesel from the strategic reserves.
I hope my dear colleague is listening, who just bought himself a diesel car about 4 weeks ago, and now ruining it. But okay, so let's move on to the LME story, the nickel story, which, while it started off relatively confined to just the commodities world, has over the last few weeks has made its way to the back pages of many of the broadsheets and even the front pages. And I think there's a couple of elements to draw out here. One is obviously how an exchange effectively ceased and the consequences of that, and some of the moral hazard challenges around that. But also a bigger question, which is, have people who've been financing these trades on the back end, the big banks, and we're starting to see this story emerge, have they been fundamentally mispricing commodity risk in this new environment? Can you just, for those who may not be as aware, can you just set up the LME and nickel story for us? What happened and why?
Well, the LME story was a big short squeeze. What we mean by that, there was a Chinese company and a Chinese tycoon that took a bet that nickel prices were going to drop, opened short positions that they were going to benefit from that. Those short positions were held not only on the London Metal Exchange, which is the biggest marketplace for metal trading, price discovery, risk management, but also on the over-the-counter market through several banks, notably JP Morgan. Russia is a big producer of nickel, and the war started. The fear was that the nickel supplies for Russia were going to be at risk. So the price of nickel started to go up and up and up. And that started to force the Chinese holder to basically buy back some of those positions. He was hit by margin calls on his positions. The banks were getting very nervous about whether he was going to be able to pay those margin calls. At times he paid late, and everything kind of exploded in a moment where the price of nickel just went up 250% in the matters of only a few hours, a day and a half. It hit an all-time high of more than $100,000 per ton, which was more than double the previous ever peak. And that forced the exchange to stop trading. And not only that, but took the very unusual and extremely contested measure of canceling trades that have happened during several hours, and it just basically deemed them as they have never took place. Um, Chinese company reached a deal with his banks to be able to refinance positions and so on. But it has been a huge mess. The market has lost all the kind of liquidity. There are a lot of customers who are extremely unhappy because their trades were cancelled. And now both the Bank of England, the Financial Conduct Authority, the UK regulators are just reviewing all the events that happen and how that was possible. And potentially some sanctions may be coming in the medium term.
Okay, so the other exchanges have been very vocal about, why they now represent, in their view, a better platform for traders. But the moral hazard story here is significant, right? Is that, and has huge ramifications for traders. Can you just help us understand, like, why those decisions were made and what the long-term impact might be of financial traders, etc., and how they can, I guess, even risk manage in a world where the exchanges themselves might pull back on trades, cancel them, etc.
Well, I mean, the big decision, which was stop trading, which I understand, and indeed I argue that it should have come earlier. It was very clear before the exchange, about 12 hours before the exchange shut down trading, that the market was completely not orderly. I have gone already up 90% on one single day. And looking at how the market was trading, it was clear that the market was not orderly. And I think that the exchange should have shut down trading at that point without having to cancel any trades. I find unbelievable that the British financial regulator and the Bank of England have not a say in the LME continuing trading, or that they raised no objections to that. I mean, clearly they were sleeping at the wheel because it was clearly a disorderly market. And then when the market went up again another 75% or so, and reached this all-time high, the exchange shut down trading. But then the cancellation of the trades goes to well. The main problem at that point was that the price have increased so much that whoever was short was facing humongously large margin calls on those positions. Their brokers have to put those margin calls first with the exchange. And the exchange has said publicly that they believe that several brokers may have failed that morning at 9 o'clock in the morning, London time, which is the margins are due. My understanding is that at least 4 brokers were at risk of collapse that morning, perhaps up to 5 brokers at risk of collapse. So the exchange decided to cancel all those trades at the record prices, so to preserve the financial stability of those brokers. So those brokers didn't face bankruptcy. And the question will have been, if those brokers have failed, will the clearing house of the exchange will have survived? The exchange have always said there was no question that about the clearing house. Perhaps it will have survived, but I think it will have suffered a massive hit if 4 or 5 big brokers have collapsed. Amazingly to me, when trading restarted, no one asked those brokers and say, gentlemen, this is the time for raising more equity. You can't. You came really very close to the cliff, and we cannot be there. Yes, we have now price limits, etc., etc. But your equity is inadequate to hold the positions that you are carrying on behalf of your clients. I think that those brokers should have been forced to raise equity immediately. And that's what we did in 2007, 2008 during the financial crisis. There was support to the banks and brokers and the system, but then that came into equity dilution. I mean, the shareholders lost, and the owners of those brokers should have raised equity. I am still mesmerized that didn't happen.
And that's going to come up again very shortly. Okay, so there was a big squeeze here, and there's also some unique elements to how the LME operates that exacerbated this story, or indeed allowed it to happen. But is this indicative of a more systemic issue that we saw disorderly markets in nickel, in part because of this big squeeze, but also, as a result of the commodity super cycle, a run up in prices, extreme volatility due to geopolitical events. And this really is crucial to our next segment. But could we, is disorderly markets, is this the canary in the mine? Could we see this happen in other products, other exchanges?
Yes, we can. I mean, I think that the whole market is very aware that trading on electricity markets can be very challenging in the next few weeks or months as the Russian invasion of Ukraine continues. The same applies for the European main gas markets, both in the continent TTF and the national balancing point here in the United Kingdom. I mean, those markets have seen at times trading patterns that didn't look particularly orderly to me. Things have calmed down and so on, but traders are facing huge margin calls. Initiation margins are very high. It's very costly to trade now, but that it just goes with the territory. The exchanges need to be aware of the volatility, and particularly the clearing houses of those exchanges need to protect the stability of the clearing house above everything else. We cannot have a situation in which just to make trading cheaper so everyone can trade and everyone can speculate, we put the exchanges and their clearing houses at risk. Because if we have learned something from 2008 is that a lot of the risk now has been transferred into the clearing houses. So they are too big to fail. The clearing houses cannot fail, and therefore they will protect themselves with a lot of force, and that is increasing margins, both variation and initiation. And that is making trading difficult. Liquidity is coming down, but I think that that's needed. I don't think that. I know that that's a problem to many people, but I don't think that that's a bad thing. That particularly initiation margins, have got more expensive. Well, the market has got more volatile, and we have seen movements in prices that previously we never thought that they were possible, or were only possible one in every 5,000 years, and now they're happening one every 5 days.
Yeah, yeah. So okay, so margin calls, initiation, the price at which you have to pay to put the trade on, and obviously the volatility then creates the variation, how much margin you're posting, if I understand it right. How does 'cause there's this phrase that has been starting to be used, the doom loop. And it's it's creeping towards sort of again sort of mainstream media as a potential issue that faces these the commodity markets, the and this disorderly markets plays into that. What can you just tell us how one person's margin call becomes everyone's issue quite quickly?
Well, yeah, I mean the doom loop. It's something that initially started more on the banking industry, referring to situations in which the price of bonds come down, and that reduce liquidity and the ability to the banks to lend money to others. But it has an application in commodity markets, and basically it just the higher the price goes, the bigger the margin calls are getting. That is draining liquidity from the system, potentially forcing some people to get out with buyback short positions, would put the price even higher because you are really buying, which increase the size of the variation margin even higher, hitting someone else, etc., etc. And at the end of the day, that process goes through several cycles. Even the most financially robust commodity traders may be in trouble just because the price gets to levels which stops being just a price and becomes more a number. And we saw that in nickel when the market goes from $30,000 a ton to $100,000 a ton. There was no supply and demand, physical supply and demand need for the price of nickel to go there. It was just the particular ways and means of how the LME works, and then the financial flows would determine that. And the margin calls are getting very 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 large. I mean, according to the European Federation of Energy Traders, which is the lobby group for the industry, for the energy traders, companies that were facing initiation margins of about $1 billion last summer, they were seeing in October about $4 billion of initiation margins, and by March 2022 that was $6 billion. And the same thing in terms of variation margins. A company that will have expected to face daily margin calls with cash outflows of around $50 million was seeing a few weeks ago cash outflows for margin calls of about $500 million. That's 10 times. And obviously, those are numbers that many chief financial officers were not prepared to initially. And that really put a big squeeze on the finances of many commodity traders, whether independent or on the back of the larger organizations like utilities or oil companies.
Yeah. Again, this is in effect markets working right now. It's a fundamental repricing of commodities risk in this new environment after a long period of low volatility and low prices. During that period of low volatility and low prices, lots and associated sanctions we've covered this on a previous episode, and scandal, particularly in Asia, lots of the traditional commodity banks, many of the French ones and European ones, either exited the space entirely or very much scaled down their businesses. So we were already tight financing coming into this, which is where we've seen, before we come on to that extraordinary letter from the Federation you mentioned to the European Central Bank, we'd already seen the large trading houses, and you did mention that small ones are going to be real trouble, large trading houses trying to reach out to alternative funds, private equity, etc., to try and build the balances up to be able to tackle these extraordinary initiation margin requirements now needed to participate in their business.
Yeah, I mean, I think that to me there are three elements there. One is that the traders have got a lot larger, particularly the large ones, even the medium size, they have got a lot larger. I mean, a company that in the past, only a few years ago, perhaps 10, 15 years ago, was managing something like 3, 4 million barrels a day, is today doing north of 8. The company that previously was doing no more than a million barrels a day today is closer to 3 or 4, and everything in between. So the size of the commodity traders have got a lot larger, and one wonders whether the equity base of those companies have got large enough to manage the new flows. Then, as you rightly point, we have seen the exit of a number of big banks who have traditionally big financiers of the industry. And I'm thinking about, in particular, BNP Paribas, which departed in 2014, and ABN AMRO, the Dutch bank, we departed more recently. But a lot of the reason that these banks left was because of scandals within the industry. BNP Paribas, in part because it got hit by a scandal, and ABN AMRO because of the collapse of Hin Leon in Singapore. These were problems within the commodity industry that the commodity industry didn't do much about it. They need to know that they need the banks alongside, and I think that the industry took the banking industry for granted. And then there has been another problem, and is that the banks seem to have mispriced the risk of commodity trade finance. I mean, this was seen as something that it was low return but very safe. And the last few years, it has demonstrated that it's low return but actually not that safe because of fraud. And banks have lost money. And at some point, the big executives above the commodity trade finance divisions are asking why we are in this business. We are committing quite a lot of capital, particularly after several regulatory changes like Basel III. We are not making a lot of money. We are taking quite a lot of more risk. And actually, we are getting involved with an industry that it is on the wrong side of the headlines every other day. I mean, we have had many big commodity trading houses admitting to bribery and money laundering in recent years. I'm not talking about the 70s, the 80s, or the 90s. I'm talking about the last 24 months. And I think that that makes the banks very nervous. And I think that they are right about being nervous.
Don't want to talk specifics, but you've had obviously these trading houses and traders and so forth that don't have the parent company guarantees and large balance sheets, etc. Seeking alternative funds, whether that's from private equity, private debt, whatever that might be. It seems like those organizations are equally unwilling to support those industries or the traders because, again, of the challenges of the risks.
I think that some of them are willing to support the traders in some ways. I mean, we have seen quite a lot of money from the sovereign wealth fund industry coming into the commodity traders, but they're coming as equity partners. They want to profit from both the downside and I mean, they want to be exposed to the upside as much as risking the downside. So we have seen, I mean, there are public examples. We have seen Louis Dreyfus getting the sovereign wealth fund of Abu Dhabi. We have seen the one entity of the sovereign wealth fund of Saudi Arabia recently investing in Olam. Obviously, Qatar remains one of the largest shareholders of Glencore, and Beetle has a very close relationship with the sovereign wealth fund of Abu Dhabi and other pools of capital. So we have seen that these private sources of capital or public sources, in the case of sovereign wealth funds, they're willing to help the commodity trading houses, but their preference so far has been to invest either in the equity of the commodity traders or co-invest into assets. What they have not been willing is to finance the revolving credit facilities. And I don't see why they should be doing that. I mean, I think that if the commodity traders need money, I'm afraid that they are going to have to share a lot of the upside also with the new financiers, and not just do an ad hoc relationship for just a few transactions.
Yeah, and it's the return on equity that has just been so extraordinary over the last 10, 15 years for these organizations.
Well, and that's the reason that the sovereign wealth funds will like to be participating on the equity, because that's where the money has been made.
Yeah. Just before I want to move on to that extraordinary letter and the consequences of that, but I think it's just worthwhile pausing. And I've heard this the conference I attended a couple of weeks ago. I won't mention the provider of the conference, deferent to Bloomberg, but
Is that the conference that I used to organize?
yes, it is the conference you used to organize,
You could say the
which was
name.
doing
That's fine. It's still a very good conference, I will say.
Yes, exactly. There was talk, or there's sort of this mentions of, um, the potential of as serious an issue as the global financial crisis were the commodity markets, and this just sounds extraordinary to say, to become completely disorganized and liquidity dry up and effectively price discovery ceases. Is that a potential, and how cataclysmic would that be?
I think it's a potential because, I mean, probably we are the closest to be in a situation of effective war with Russia, as we have seen probably for the last 40 years here in Europe. I mean, let's not kid ourselves. We are arming Ukraine and we are doing it on broad daylight. This is not as used to be sending the planes at night and making sure that no one was seen in the airport during the daylight because, officially everyone was denying that anyone was supplying weapons to someone. I mean, this is happening on broad daylight. I mean, we are fighting a war with Russia using a proxy of Ukraine. Russia is one of the world's largest commodity producers across a huge range of commodities we have been discussing. So if the conflict really becomes more widespread, we can see a completely shutdown of the oil flow, the gas flow, and yes, the market will become completely disorderly. But you will expect that, and I think that then a lot of more measures will come. I mean, if there is a shutdown of gas, and if Russia shuts down gas supply to Europe for whatever the reason is in the next few weeks, because Europe refuses this request from President Vladimir Putin of paying in rubles, I think that yes, the market will be disorderly, but I think that will be the less of the concerns in the sense that I will expect that the European industry will be quasi-nationalized almost overnight, and price controls on energy will need to be introduced. I mean, we will be rationing gas and telling which industry is going to get gas and when. So whether a particular exchange is going to have problems with margin calls, I think that it's going to be completely secondary to that. I mean, I will be expecting that TTF trading will stop because the European Union will shut down the market.
I mean, that just sounds so dramatic. It's so incredible to
But
me.
just in mind that we lose 40% of gas supply. I mean, one of the problems here is that we need to go back to the mentality of the early days of COVID when people were saying, oh, we cannot do this or we cannot do that. And we did that and many other things. We are in a situation that is absolutely extraordinary. And if we lose, because either we have to impose sanctions on Russia or because Russia cuts the supply, we lose the flow of Russian energy. Actions that today seem completely unthinkable will be needed to take. Uh,
Is that risk priced in your opinion, today?
I don't think so. I'm finding quite puzzling how little risk the market is pricing of these actions. In part because nothing has happened. In part because um, I think that these movements take a bit of time. I mean, it took time from the market to realize the extent of the oversupply in oil during the early days of COVID. I mean, I do remember when we at Bloomberg published our first big story of COVID and oil, which was in early February, which the headline basically read, China oil demand has collapsed by 20%. The reaction of the industry was in disbelief. And guess what? We were wrong. It was much larger than 20%. And then global oil demand dropped by more than 20%. And then we went to negative prices. But that took about, from the moment that things really got bad to the moment that we got negative prices, it took about 12 weeks. And the market took a time to really price in all of that. And I think that we are in a similar situation. And I think that the market, and myself, we are really hoping that none of all of these really bad scenarios come. But is there a scenario in which Europe loses gas supply? Yes, I think that there is. And I certainly think there is more than 5%, as some people say.
Yeah, and I should mention we're recording this on April 8th, just in case in the in the time between us recording and it being published.
I really hope that in the time of recording this and publication, we don't have the interruption on supply. But it seems that the market is quite. It seems that in general the market is really hoping for the best.
Yes, as they are wont to do. Let's move on to just talk about this letter from the Trade Federation to the European Central Bank, essentially asking for support in the face of these margin calls. The global commodity trading sector and the independent trading houses within it have spent much treasure and time over the last 15 years talking about how they're not a systemic risk and they're not too big to fail and effectively shouldn't be regulated as such. Can you just describe what this letter was? Was it broadly supported? And obviously, we now know that it's been rebuffed, but there's some serious consequences, even just by the act of sending the letter. Can you just walk us through that?
Well, this letter came from the European Federation of Energy Traders, which is an industry association. It's actually headquartered in Amsterdam. And it's basically the lobby group for the energy traders when they are dealing with the European Union in particular. And it represents lots of people in the industry, from the in-house commodity trading desk of the oil majors to the big utilities across France, Germany, Central Europe, to the independent traders in Switzerland, to some of the banks. And the Federation sent this letter on March the 8th. So we were at the peak, really, of the tensions. The war has just started. And I think that the two main points of this letter were coming on the summary of the letter. And one is high and volatile energy prices are leading to intolerable cash liquidity pressure for energy market participants. That was verbatim from the letter. That was the first point that the letter made. And then the third point that the letter made was a request for liquidity support should be provided by governments or public or financial public law institutions, as reference to central banks. And to me, this was extraordinary because it basically said, uh, in layman terms, we need a taxpayer bailout, which is the last thing I would have ever thought that the commodity trading industry was going to ask. And I was surprised for two reasons. One is because, as you very well say, Paul, the industry has spent quite a lot of time, effort, energy, money to convince everyone that not only they are not too big to fail, but they are just not, as I usually say, they're too big to be ignored. The industry actually wanted to be ignored and let alone, and just operate under the radar. And this really puts the industry, all of a sudden policymakers realize, hold on one second, these guys who have told us for so many years, don't worry about us, we are big boys market, we know how to handle this, the industry can self-regulate. All of a sudden policymakers realize, hold on one second, no, the industry cannot self-regulate itself. They are in deep trouble right now, and actually this matters a lot more than we thought. What's going on here? So that was one. And the second point to me that was very interesting, that this request came before we saw anyone in the industry trying to raise equity. So you are asking for taxpayer financial support, and the industry has not even tried to do it itself. I know that everyone was reaching out to their banks. I know that there were conversations with private equity vehicles and so on, but the industry itself, in many cases, privately owned, they can go to themselves, they can go to other investors and raise equity. Yes, that will dilute current shareholders, but well, that's the price that you pay when you are in a pinch. We saw Glencore a few years ago when his shares collapsed. They have a problem with debt. The market lost confidence in the ability of Glencore to repay the debt. And in a few hours, Glencore put together an emergency equity raising. They sold shares, and the staff, the senior executives of the company, led at that point by Ivan Glassenberg, put from their pocket, if I remember correctly, $800 million, and then London-based investors put the rest up to $2.3 billion. And we have not even seen that. We saw no attempts by the industry to try to resolve the problem within the industry, but then went straight to support from the ECB. which was really naive, because it's clear on the mandate of the ECB that they will not support these kind of companies. They are not financial companies. They're just completely outside the mandate of the ECB. So I don't really know what was the thinking behind this. I know that the letter does not have the unanimous support from the industry. There are a number of commodity traders that they are not happy of what the letter said and how the letter, let's say, language and communication was handled, because this was clear that it was going to leak.
Yeah, I was going to say, yes, it was. It didn't seem like it had universal. Well, we know it didn't have universal support within the sector. Has this raised the hoary spectre of regulation, come what may now, and what might that look like for the commodity trading sector?
I don't know how it's going to look like, but certainly I have got myself more phone calls from regulators over the last few weeks about this letter, and how surprised those regulators were about the size of the industry, the importance of the industry, and the fact that it was completely and largely unregulated, that I have in a very long time. And I think that this was like this room that it was in darkness, and all of a sudden someone switched the flick the switch, and light came, and then policymakers really awoke to the fact that they know very little about the industry, that the industry is largely self-regulated, and that all of a sudden they realize that there could be problematic. And I think that after this letter, I will expect to see central banks and financial regulators taking a lot more interest about the industry.
Yes. So it's I mean it's just remarkable, from when we started this podcast, 2 years ago, albeit in the height of the start of COVID, just how much at the forefront of global news, global politics, the commodity sector is, and just how the next few months might be some of the most volatile in its entire history.
Absolutely. I mean, it is just it has been a remarkable roller coaster, and I don't think that we are done, because even if and hopefully soon peace is achieved in Ukraine, and the aggression of Russia ends, a lot of the trouble predates the war, the lack of investment, the runaway demand. A lot of the trends that we are seeing today have been masked by COVID, and now they are all of a sudden accelerated by the war. But we have a problem before the war started with lack of investment in oil, and demand of oil was rising very rapidly. Just COVID put a bit of a stop to that, but that was a false stop. The moment that the restrictions were lifted, everyone is back driving and flying around. And I like to use the example of coal. I mean, people think that it's on his way out, and coal demand is going to hit an all-time high in 2022. And this is the most polluting source of energy, and the one that you just walk on the street and ask a random person where that person thinks that coal demand is compared to 10 years ago, and most likely the answer is going to be, well, it's down, because that's what is on the public perception, that we are fighting climate change, and we are getting rid of coal. And well, that's not the case. Coal demand is much higher than 10 years ago, and it's about to hit an all-time high.
Trading profits from coal as well. So it's again, all part of the cycle of certain traders have exited the space as a result of the demands from financing or self-mandating to do so, and others haven't, and that's causing the degrading of the markets and the volatility that then ensues. So
there is very little finance for the industry. I mean, even today at $100 plus and record prices for coal, very few investors are coming into the sector and saying, yes, I want to put money here, and I want to put this money to grow.
Well, Javier, it has been an absolute joy having you on. Look forward to having you back, probably sooner rather than later, given the ongoing events. And I think there's some significant takeaways about the reality that commodity price risk has probably been undervalued these last few years.
A pleasure always, Paul, to be on the podcast. Thank you for having me.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify.
To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world. There you can also find more content, from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.